I will kick off today just to set our agenda for the day. We are going to start by discussing considerations and the recent amendments made to the MDNA section of Form 20F and the financial statement requirements applicable to foreign private issuers. Next, I'll cover key performance indicators and non-GAAP measures, particularly focusing on financial metrics relating to the COVID-19 pandemic. Then Christina will review areas of focus for SEC comments in anticipation of this year's 20F filing season. She'll also detail the SEC's and PCAOB's implementation of the Holding Foreign Companies Accountability Act. And finally, we'll end today's presentation with an overview of areas of likely SEC focus in the coming months. So with that agenda, I'll kick off. Next slide, following slide. So I'm going to detail the MDNA amendments that just became required as of the second half of last year. So this is especially important in the context of upcoming 20F filings, as they will be the first for many companies to now be subject to the new disclosure rules. So this slide sets forth an overview of the basic MDNA requirement. Annual reports for foreign private issuers are required to contain or incorporate by reference an operating and financial review and prospects section. This essentially contains the same information as the MDNA section does for U.S. Domestic companies. On the slide here, we provide the general purpose of the MDNA, which is to provide investors with management's explanation of factors that have materially affected the company's historical financial condition and results of operation, and an assessment of known trends and uncertainties that management anticipates will have a material effect in the future. The MDNA section is meant to allow investors to view the company from management's perspective. It will identify and discuss the key metrics and any other statistical data that management uses to evaluate the business performance of the company, its financial health, liquidity, and anything else that management believes investors need to properly make an investment in that company. The analysis needs to cover all segments, such as different product lines that foreign private issuer has, different geographical regions that company operates in, so it should be broken up by segment. It should also refer to the reconciliation to U.S. GAAP if the foreign private issuer doesn't use U.S. GAAP as its main accounting principle. It needs to discuss any aspects of U.S. GAAP that are not covered in that reconciliation that it believes are necessary to fully understanding the financial statements as a whole, which are attached to the 20F in the back. The MDNA covers operating results by describing the significant factors materially affecting the company's income from operations, including changes such as changes to its sales or revenue from period to period, and what are the reasons for those changes, providing a narrative that tells a story and provides insight into the direction and trends that company is going. Is it related? Are those changes related to foreign currency fluctuations? Was a new product or new service introduced that resulted in these changes? Did the company change its prices due to inflationary pressures, perhaps, or other impacts during that period? Were there governmental policies that were instituted that had an impact on the company's results? So there should be a significant, time and attention devoted to the operating results section. Next section in the MDNA is liquidity. and capital resources. This covers the company's ability to generate and obtain adequate amounts of cash to meet its requirements in both the short term and the long term. What are its plans for the cash? Primarily focusing in the next 12 months, and then separately longer term CapEx agenda and plans. Perhaps most importantly, the MDNA needs to broadly in all of its areas capture trend information. The company needs to identify known trends, uncertainties that are reasonably likely to have a material effect on its sales, revenues, profitability, liquidity, anything that would cause its financial information not necessarily to be indicative of future operating results. Those need to be disclosed. Next slide. So with that general MDNA framework, what were the focus of these most recent amendments? So as background, they were adopted by the SEC at the end of 2020 with an intention of continuing the SEC's broader efforts of modernizing and simplifying certain of the financial disclosure requirements and just disclosure more generally that the prior administration was pursuing at that time. The SEC's goal was to eliminate duplicative disclosures and also enhance the readability and the benefit of the MDNA to investors by more tailoring it to the specific company. And it was intended to have the added benefit of simplifying compliance efforts for public companies, I think, as well. The resulting disclosure, should really be enhancing the readability, discouraging repetition, eliminating information that is not material to the company. Before we get into the detail of those amendments, it's worth noting that they were adopted, as I mentioned, in the prior administration in a split partisan 3-2 vote. And now that we've had a change in the administration, those dissenting voters are now in as part of the majority of the SEC commissioners now. And so that's entirely, important because there may be more changes, certainly on the horizon in other areas related to, climate change and ESG risk, human capital, whatnot, that Christina will get into a little later. But next slide. So focusing on the particulars here, a few changes to that results of operations section that I described. First, companies are required to disclose known events that are reasonably likely to cause a material change in the relationship between costs and revenues. So this change uses a disclosure threshold of reasonably likely, which is consistent with the SEC's guidelines on forward-looking statements. So the reasonably likely threshold is what should trigger disclosure. So if a company knows of events that are reasonably likely to cause, as opposed to will cause, a material change in the relationship between costs and revenues, such as a reasonably likely change in the cost of labor, or price increases or inflationary pressures, inventory adjustments, any of those that are reasonably likely will trigger disclosure describing that reasonably likely change in the relationship. As a result, that reasonably likely threshold inherently requires a thoughtful analysis that applies an objective assessment of the likelihood that an event will occur, balanced with a materiality analysis regarding the need for the disclosure. So it's those two things, reasonably likely and that materiality threshold. Known trends that are not remote, or where management cannot make an assessment as to the likelihood that they'll come to fruition, and that would be reasonably likely to have a material effect on the company's financial condition. Those need to be disclosed. So management needs to make this determination with an overall goal of helping readers to understand the direction that the company is likely to go in. As mentioned on the bottom of this slide, companies are also required to disclose the reasons underlying those changes in net sales or revenue. So this simplified existing MDNA guidance, which was meant to encourage companies to provide more nuanced, tailored information as to the factors that are contributing to material changes in line items, rather than just simply regurgitating the quantitative difference between periods. Lastly, on this slide, as part of the results of operations changes, the SEC eliminated the prior disclosure requirement with respect to the impact of inflation and changing prices. Nonetheless, especially in today's environment, depending upon the type of company, these types of disclosures are still going to be required if they're part of that known trend. So even though the particular generic requirement is eliminated, it's still very likely to be part of a known trend that is reasonably likely to have a material impact, and that's the new kind of trigger. Next slide. So the SEC also eliminated the off-balance sheet separate requirement. This was, replaced for companies to describe commitments arising from arrangements with unconsolidated entities that have, or again, reasonably likely to have a material effect on the company's financial condition. Those still need to be disclosed. So really, in a sense, they're just getting rid of the requirement to have the subsection. But if it still triggers what I've kind of discussed as that new threshold, then disclosure will still be required there. It just provides more flexibility. Next slide. So companies that do not prepare financial statements in accordance with IASB IFRS, which I'll explain shortly, they need to provide information about accounting estimates or assumptions that are uncertain and reasonably likely to have a material impact on the issuers, the foreign private companies' financial statements. This disclosure needs to include both qualitative and quantitative information necessary to understand the uncertainty and the impact that the critical accounting estimate has had or is reasonably likely to have, to the extent the information is material and reasonably available. It needs to be reasonably available. That's the addition onto this aspect of it. Next slide. So I'll turn attention from the MDNA to the financial statements. U.S. domestic companies need to file financial statements with the SEC, obviously in accordance with U.S. GAAP. As we know, the financial statements of foreign private issuers may be prepared using U.S. GAAP, of course, but there's also the ability to use International Financial Reporting Standards, or IFRS, or home country generally accepted accounting principles, so-called local home country GAAP. In the case of foreign private issuers that use the English language version of IFRS, as issued by the International Accounting Standards Board, or IASB IFRS, no reconciliation to US GAAP is needed. So that's very important. By contrast, if you're using that local GAAP, the home country GAAP, or non-IASB IFRS, then a note to the consolidated financial statements needs to be included in the 20F that reconciles that to US GAAP. So that's important to know, as obviously it takes time to prepare that note. Foreign private issuers that voluntarily file on domestic forms, such as Form 10K, they may file financial statements under IASB IFRS, but they need to prominently disclose that the company meets the foreign private issuer test and is essentially voluntarily filing on those domestic forms. Audited financials need to be accompanied by an audit report covering each of the audited periods. The SEC generally will not accept a disclaimer of an audit opinion, so it needs to be clean without qualification, and it needs to state that the audit was conducted in accordance with PCAOB standards. In addition, an accounting firm, US or non-US, that prepares or issues any audit report with respect to the company obviously plays a substantial role in putting together, in helping to review the 20F. The audit report is included, and of course that audit firm needs to be registered with the PCAOB. Needs to also address critical audit matters and information about the auditor's tenure in serving as the company's independent auditor, and the independence of that auditor needs to be included as well. Companies that are emerging growth companies, or EGCs, are not subject to the critical audit matters requirement, but they still need to include the auditor tenure information. Foreign private issuers may state amounts in their financial statements in any currency they deem appropriate. So that's the so-called reporting currency that's used in their financial statements. Companies that are experiencing high levels of inflation in that currency should generally be measured also using the currency of their primary economic environment to measure transactions. So should really be comparing it with a US dollars translation, and that should be prominently included on the face of the financial statements. Next slide. Okay, so this next slide provides a nice illustration of the periods that are now required, triggering Rule 305 financial statements. These are the financial statements that need to be included in the event that the issuer has engaged in a significant acquisition of another company. And so the amendments tweak the triggering thresholds, the significance thresholds that would trigger these 305 financial statements under Regulation SX. The purpose here was, again, the SEC aiming to improve the quality of information being made available to investors through these financial statements, and the impacts of not just significant acquisitions but also dispositions for the company and those public investors. Among the most important amendments are that the investment and income test used in determining which business acquisition or disposition is considered significant was changed. So thereby it's a different threshold on whether the target financial statements need to be included, whether you're hitting, whether you're below that 20% level or between 20% and 40%, in which case 1 year of audits are required, or greater than 40%, in which case you trigger the 2 year audits. Next slide. So the next several slides really just provide practical guidance considerations and can be used as a reference in the event that the foreign private issuer has made a material acquisition during the reporting period, and may be triggering the 305 financials. In short, I mean, the financials are limited to the historical financial requirement not to exceed 2 years of the historical financial statements of the target, and so as a result, the third year that had been required was dispensed with, and financial statements for the most recent interim period need to be included if you're above that 20% threshold. With respect to foreign businesses, 305 financial statements may be prepared in accordance with IFRS without reconciling to US GAAP if the acquired business would qualify to use IFRS if it were a registrant itself. Next, so skipping ahead next few slides here, I think jump into our next section on key performance indicators. So in 2020, the SEC issued guidance regarding the disclosure of key performance indicators, or KPIs, that are typically included in the MDNA section of both US and foreign private issuers in their annual reports. So for several years now, the staff has expressed concerns regarding the use of KPIs similar to the use of non-GAAP financial measures as well. And the enforcement division of the staff has even taken action in certain circumstances, bringing enforcement action against certain issuers and management that have been allegedly using KPIs in a manipulative way. Most recently, following the issuance of the guidance, the SEC charged a global alcohol producer with disclosure failures resulting from its reported higher growth in certain KPIs that were closely followed by analysts and investors. The order alleged that the management team of the company failed to disclose the known trends relating to the KPI that was used. So as a result, investors were left with the misleading impression that the growth in that KPI was due to increased demand for the issuer's products, as opposed to the actual unrelated reasons for that growth. So, those recent charges combined with the recent statements from the SEC, I think really do highlight that this is an area of focus. And a lot of time and attention should be devoted to making sure that the KPI is properly disclosed, going back to that threshold that we talked about, of that reasonably likely to have a material impact. So what is a KPI? A KPI is essentially a measurement that assesses a company's performance in relation to a key business objective. A KPI is often not subject to generally accepted accounting principles and is typically not included in a company's financial statements. So KPIs are inherently have the potential to be more subjective and potentially susceptible to being manipulated and misleading investors, which is why there's such a focus here. The SEC's guidance reminds companies when it comes to KPIs that additional information needs to be included, that additional information, if it's necessary to make the presentation of that particular KPI not misleading. So, very generalized statement there, not dissimilar to the existing regulatory framework that's been around relating to Regulation G for non-GAAP measures and the like, or just Regulation SK just generally in terms of disclosure obligations more broadly. So that framework very much applies in the context of KPIs that are used. The SEC generally expects that a KPI be accompanied by a clear definition of what it is and how it is calculated, a statement indicating the reasons why the KPI provides useful information to investors, and a statement indicating how management uses the KPI in managing or monitoring the performance of its business. Next slide. So according to the SEC's guidance, a company needs to consider underlying estimates or assumptions for a KPI that needs to be disclosed in order for the KPI not to be materially misleading. So if a company changes the KPI's presentation from one period to another, if this year's 20F is going to be tweaking that KPI that had been historically used, then disclosure needs to be provided for the difference in the way the KPI is presented, the reason for the change, the effects of the change, and any other differences that would reasonably be expected to be relevant to an understanding of the foreign private issuer's performance. Depending upon that significance, it may be necessary to recast prior KPIs in past annual reports to the current presentation and place that current disclosure in an appropriate context if one is changing it. Next slide. So the final topic here before I hand it over to Christina relates to non-GAAP measures and issues related to the COVID-19 pandemic. So at the onset of the pandemic a couple of years ago, the SEC's Division of Corporation Finance, the staff there issued detailed guidance to help companies meet their disclosure obligations and consider the impact of the pandemic in their periodic reports. Following that guidance, the SEC has issued many comments to both U.S. and foreign private issuers on the company's use of accounting of pandemic-related issues and disclosure related thereto. So the effects of the pandemic on the company's results have obviously been significant depending upon what industry the company is in. But in either way, the SEC has issued many comments just asking for companies to tailor disclosure more specifically to the impact to the company, making sure that companies are explaining their results in a way that is clear and understandable to investors. Has that company received governmental assistance, for example? What was the usage of that government assistance? When does that government assistance need to be repaid? Those kind of disclosures. Next slide, we provide here just a typical SEC staff comment that we've seen issued just over the past year. Out on the bottom of that slide. Here, they're asking for additional information as to the results of operations, liquidity and capital resources disclosure to be enhanced, much along the lines of what I described on the first half of the presentation. So next slide. So as a result of the uncertainty and the impact, obviously, on the GAAP financial statements, many companies, including foreign private issuers, have used non-GAAP measures to recognize or exclude significant but infrequent or unusual gains, charges, or other losses attributable to the pandemic and that are not expected to be reoccurring. That is the threshold that the staff has been focused on, is whether the adjustments that are part of that non-GAAP measure, are they truly non-recurring, or given the new normal in that particular industry for that particular issuer, is it more expected that this will be just part of a recurring, ongoing adjustment that really is an inappropriate adjustment to create a non-GAAP measure. So the SEC issued a number of C&Is on this topic, making clear that non-GAAP measures that could potentially mislead investors, are ones that exclude normal recurring cash operating expenses that are necessary for business operations, or that are presented inconsistently between periods. So it needs to be consistent, or any adjustments that exclude certain non-recurring charges, but not excluding other non-recurring gains. So essentially, cherry picking between non-GAAP adjustments to achieve a certain positive outcome. That's what the staff is significantly focused on there. So with that, I will hand the presentation over to Christina to cover this year's new requirements and topical issues that are front of mind at the SEC staff.
Thank you so much, Brian, and thank you to everyone joining us this afternoon. So to start out, just a few new items that I wanted to flag for everyone's attention. So there are new annual report disclosure requirements this year. And people may not have been paying very close attention to these. So the SEC amended forms 10K, 20F, and 40F to include new items 9C and 16I and B18 respectively. And that's to implement the Holding Foreign Companies Accountable Act, which I'll cover a little bit later in the presentation. So the reason many have not been paying attention is because this doesn't necessarily apply to everyone, but wanted to flag it because you are going to have to amend your filing to include these items. And if they're not applicable, state that they're not applicable, but if they are applicable, you'll have additional disclosure to provide. And so this is, just to give a slight preview, this relates to disclosure regarding foreign jurisdictions that prevent inspections by the PCAOB or the SEC. And currently the PCAOB has identified registered public accounting firms headquartered in mainland China and Hong Kong. And so the SEC is going to be using annual reports, starting with those covering fiscal year 2021, to identify registrants for purposes of a potential future delisting of those companies' securities. So relatedly, there are new data tagging requirements, and these were adopted in the rulemaking for the Holding Foreign Companies Accountable Act, but they apply to, so everyone has to disclose now the name of the auditor and the location of the audit report issuance, which, as you all know, is already disclosed in the signature page to the audit report. But going forward, you'll also have to disclose your audit firm's PCAOB ID number. So that's information that you can easily get from your auditor. But what's a little bit tricky now is that all of this information is going to have to be tagged. And the SEC was not specific about where this information should be tagged. So it left it up to the discretion of each company. But what you'll want to do is talk to your audit firm. Since the location of information is not specified by the SEC, different audit firms may have different views on where that information should be provided. And so just, be aware this is something now Edgar won't accept your filing if you don't have these three elements tagged. Next slide, please. Okay, another new requirement is applicable only to NASDAQ listed companies right now, but NASDAQ has new board diversity standards that the SEC approved, and this is going to require NASDAQ listed companies to have or explain why they do not have at least 2 diverse directors. So it's a comply or explain approach, and it requires at least 1 director who self-identifies as female, regardless of designation at birth, and at least 1 director who self-identifies as either an underrepresented minority or as LGBTQ+. So that's the general rule, and there are some variations of it that would apply to different types of issuers. So for foreign issuers, for example, and this includes foreign private issuers, you can satisfy the board composition requirement by having 2 directors who self-identify as female. So that means you would have 2 directors who self-identify as female, and you would not need to have 1 who self-identifies as either an underrepresented minority or as LGBTQ+. And there are other variations depending on the size of the board and things like that. So something to pay attention to, especially because this year is the first year they are going to require a board diversity matrix. Now, this can either go in your proxy statement or on your website. Either way, though, you have to provide it this year by August 8th. And so you want to think through as you're putting together your filings, whether you want to put it on the website or where you want to put this information, but it is going to be required to be disclosed. So NASDAQ provides the template for this board diversity matrix and doesn't allow for much divergence from what they provide. So be aware of that and know that you're going to have to disclose it by early August this year if you are a NASDAQ listed company. Next slide, please. areas of focus for SEC comments. So we wanted to highlight some SEC staff disclosure areas of focus as you're drafting this year. COVID-19 obviously is still very much an issue for many companies. Climate change, LIBOR cessation, cybersecurity, and issues related specifically to China-based issuers. Next slide, please. Okay, so SEC staff comments on COVID-19. So I think the big takeaway here is that you probably have COVID-19 disclosure in your annual report. Don't just leave it in there from last year. Make sure that you're reading everything that you provided last year and updating as necessary. So at the beginning of the pandemic, a lot of the disclosure was very general. There was a lot of uncertainty at that point, and time has passed, obviously, and the expectation now is that the issuer is going to provide more specific, tailored information, both in its risk factors and in MDNA about how it's been affected by the pandemic. So we provided a sample comment here, which essentially says, you've disclosed that your operations may be impacted by the COVID-19 pandemic, and that it will depend largely on future developments, which are highly uncertain and cannot be accurately predicted, including new information that may emerge concerning the severity of the outbreak and actions by government authorities to contain the outbreak or treat its impact. And so the staff asked the company to amend its risk factor disclosure to provide more detailed risks related to the COVID-19 pandemic, tailored to your specific facts and circumstances. And then it refers the reader to staff guidance. So by now you can't really have just these general risk factors. There may be risk factors that you want to disclose that nothing has necessarily happened, but you think it is material risk going forward, and that's fine. But you at this point should know a little bit more, especially since there has been so much activity at the local, national, and global level, to know sort of what's been done that affects you and what could be done that would possibly affect your business. So review your existing risk factors, consider whether they need to be revised to address events that have already come to pass. So things that might have been a risk at one point, maybe they're not anymore because something has happened, and so you would want to disclose that instead of leaving it as a hypothetical possible risk factor, and also address new risks that have been identified as the pandemic has become more prolonged and its effects more wide-reaching. So for instance, supply chain issues, return to work, things like that. So COVID-19 risks may have evolved over time, which would require modification, and that could be just different events that are now relevant that weren't before, such as the existence of vaccines, vaccine hesitancy, variants, and breakthrough infections. Next slide, please. So climate change has been a major area of focus for the SEC, and they've even put out a sample comment letter of comments that issuers can expect to see in response to their filings, and these are all very specific to climate change risks. So a sample comment asks the issuer to disclose the material effects of transition risks related to climate change that may affect its business, financial condition, and results of operations, such as policy and regulatory changes that could impose operational and compliance burdens, market trends that may alter business opportunities, credit risks, or technological changes. So there's a lot there that they're asking for. What you'll want to do in order to prepare for comments like this, or to determine whether you need to revise your disclosure before filing, is reread there's 2010 Commission guidance regarding disclosure related to climate change. That's what's really being relied on now by the staff, since there has not been a new rulemaking yet. And so read that, consider whether revised or enhanced disclosure is required, because this is something we've seen, comments have gone out, companies have responded, and the SEC staff hasn't necessarily been satisfied with those responses. So there's been a bit of back and forth, and really the staff is expecting you to show your work here. If you say this is not material to your business and you're not going to revise to disclose it, they want to see your analysis. So just be prepared for that. and make sure that you evaluate disclosure controls and procedures with respect to climate change, so that you're in a position to say that you're certain that this information did not need to be disclosed if that's the case. Next slide, please. So in addition to looking at SEC comments issued previously, it's also important to look at enforcement and the focus of the enforcement division at the SEC and certain matters that they've brought to get a sense of what the staff is going to be focused on. So with respect to climate, the SEC has initiated a climate and ESG task force, and relevant to issuers, the initial focus is to identify any material gaps or misstatements in issuer disclosure of climate risks under existing rules. So expect not only comments from the Division of Corporation Finance, but also that the enforcement division is looking for examples here of companies that should have disclosed material information and did not. There's also a cyber unit. The cyber unit focuses the enforcement division's cyber-related expertise on targeting cyber-related misconduct. So a lot falls under that purview, but we will highlight a little later some instances of cases that were brought recently that really demonstrate that the SEC is very focused on company cybersecurity disclosure and practices. Next slide, please. Okay, so here's the example. Pearson PLC. It's a London-based educational publishing and services company and a foreign private issuer. So they learned of a cyber breach in March 2019. The company filed a semi-annual report on Form 6K a few months later in July, and it kept the same risk factor disclosure that it had been disclosing, in each report. That framed a risk of a cyber event or data breach as hypothetical. So you can see the language there. So the SEC found that the company made misleading statements and omissions about the data breach because it provided that hypothetical language rather than revising its risk factor to say, we have in fact been the subject of a data breach, and this continues to be a risk for us, but this is something that has already come to pass for us. Next slide, please. So, so a little more on what you want to be reading and refreshing yourself on before revising your disclosure. Again, I mentioned the 2010 Commission guidance on climate change. So this will provide you with specific risks faced as a result of climate change legislation or regulation, business trends such as legal, technological, political, and scientific developments regarding climate change, and indirect risk from climate change impact on a registrant's reputation. So I'll note, this was issued in 2010, but it really was drafted in a way to withstand time. It's principles based. It shows you, for each item of Regulation SK, which hasn't changed terribly much despite different modernization and update rulemakings in the past few years, but a lot of the same, the business section's still there, the risk factor section's still there, MDNA is still there. So this guidance really shows you, in those sections, what might be information that you would want to disclose of material to your business. So very helpful to read that. In 2018, more recently, the Commission put out a statement and guidance on public company cybersecurity disclosures. And so that guidance will provide a list of issues to consider when drafting cybersecurity risk factor disclosure. And I think this sort of foreshadowed what happened in the Pearson case, because the guidance explicitly says in meeting their disclosure obligations, companies may need to disclose previous or ongoing cybersecurity incidents or other past events in order to place discussions of these risks in the appropriate context. So again, just very important to read these pieces before you finalize your reports. Next slide, please. Okay, and this one's a little more of a focus on China-based companies. And so just to note, the SEC staff recently published a sample comment letter for China-based companies, and it explains that for whether you're filing a registration statement or a periodic report, there are certain items that the SEC expects to see disclosed, and certain risks it expects to see highlighted. So as an example, I included a comment here: provide a description of how cash is transferred through your organization and disclose your intentions to distribute earnings or settle amounts owed under the VIE agreements. This is for companies who have a variable interest entity structure. State whether any transfers, dividends, or distributions have been made to date between the holding company, its subsidiaries, and consolidated VIEs or to investors, and quantify the amounts where applicable. Provide cross-references to the condensed consolidating schedule and the consolidated financial statements. So this is just one example, and it's a very particular request. And so for those with operations based in China, make sure to read this staff comment letter to try and provide this disclosure before the staff has to ask you for it. Okay, so now a little more of a deep dive on the new Holding Foreign Companies Accountable Act rulemakings. So just as background, in December 18th, 2020, President Trump signed the Holding Foreign Companies Accountable Act into law, which was bipartisan legislation passed by Congress earlier that year. And so what it does is prohibit foreign issuers from listing and trading their securities on any U.S. securities exchange or even over the counter if authorities in the foreign issuer's home jurisdiction prohibits the Public Company Accounting Oversight Boards, the PCAOB, from inspecting the issuer's registered public accounting firm. So the legislation is drafted in a very neutral manner, but it's pretty clear that it's aimed at U.S. listed Chinese companies. Because for over a decade, the SEC and the PCAOB have had issues obtaining the audit work papers from audit firms that are based in China. So this puts U.S. listed Chinese companies in a difficult position because there's not anything that the company itself can do to comply. So this is really, it targets the audit firms, but the companies are the ones who face the implications of this. So Chinese regulations impose limitations on the inspection of public accounting firms that are based in China and Hong Kong by foreign regulators. So that includes the PCAOB. So that's been the case, and even after the legislation, that's still the case. So next slide, please. Okay, so this gives a little more detail on exactly what the legislation requires. So the SEC is going to start identifying issuers that have been audited by accounting firms that the PCAOB is not able to inspect or investigate. And it will track how many years consecutively that's been the case. And so the legislation provides that after 3 consecutive years, the SEC has to prohibit trading on a national securities exchange, so the New York Stock Exchange or NASDAQ, or through any other method regulated by the SEC, which includes over-the-counter trading. The trading prohibition can be removed, but the issuer would have to certify that it has retained a registered public accounting firm that the PCAOB has inspected to the satisfaction of the SEC. And then if there's a failure to comply again, trading is suspended for a minimum of 5 years. So there are also disclosure and submission requirements, but I think the biggest concern with this legislation is that companies that are currently listed in the U.S. will suddenly be delisted. Next slide, please. Okay, so here are the disclosure requirements. So in any year when the issuer uses a PCAOB identified firm, so that's a firm that can't comply with PCAOB inspections or investigations, anytime it uses one of those firms to prepare its audit report, the issuer will have to disclose in its annual report, and this is in one of the new sections, depending on what form you use. You have to disclose that a non-PCAOB inspected accounting firm prepared the audit report, the percentage of shares of the issuer owned by governmental entities, whether the governmental entities in the foreign jurisdiction of the accounting firm have a controlling financial interest in the issuer, the name of each official of the Chinese Communist Party who is a member of the board of directors of the issuer, and whether the constitutive documents of the issuer contain any charter of the Chinese Communist Party, including the text of such charter. Next slide, please. So this is just sort of a timeline of what the SEC and PCAOB did in terms of rulemakings since the passage of the act. And so I think, we can kind of skip over this, but we're at the point now, if we go to the next slide. Okay, so we're at the point now where companies will start being identified likely this year after the filing of their annual reports covering fiscal year 2021. There will be up to 3 years before non-compliance would compel a delisting, and this could be reduced to 2 years if pending legislation is passed into law. And so, Chinese issuers might want to start considering what options they have available to exit the markets on their own terms. And so that would include going private, voluntarily delisting and deregistering in advance, or starting to consider a secondary listing outside of the US. Next slide, please. Okay, so here we go. So expected areas of SEC focus, some of these we've already talked about. Climate change. Again, read the climate change letter, read the 2010 guidance. It's the SEC has made very clear that this is a major area of focus for them. There is rulemaking on the horizon that was expected before the end of last year, but there appear to have been some delays. But we expect to see it pretty soon. Disclosure relating to climate risk, disclosure relating to human capital management, and disclosure relating to corporate board diversity. So right now, while all of these areas are required to be disclosed to the extent they're material to a company's business, we're expecting the SEC is going to have requirements going forward for much more prescriptive disclosure. So the idea being that there will be comparable disclosure no matter what company you look at. It won't matter if it's material to that company or not. It'll just be, disclose your scope 1, scope 2, and maybe even scope 3 emissions, and you'll be able to look from company to company, and for each company each year you'll be able to see what changes have occurred. And so same with human capital management. More is expected in terms of adding metrics such as workforce diversity, employee turnover, things of that nature. And then additional disclosures relating to corporate board diversity are expected as well. Next slide, please. So a couple of other SEC rulemakings that I wanted to flag. The SEC recently proposed rulemakings on Rule 10b5-1 and insider trading, as well as share repurchase disclosure modernization. And so these rule proposals are meant to address concerns of insider trading and possible manipulation that results from the way that the rules are currently drafted. And so this will, we've got some pretty good legal updates on this, I think, on our website that really kind of compare what the requirements are now, what they would be if these proposals are adopted. So I highly recommend you take a look at those two legal updates. But in essence, there's going to be a lot more disclosure required. There's a lot more safeguards around what's allowed for Rule 10b5-1 plans. Right now there's no cooling off period required in between implementation of the plan and the execution of the first trade. That's likely to change. And for share repurchases, disclosure is right now required every quarter. That's going to change if the proposal is adopted as drafted. Having to file a new form within 1 business day. So big changes are expected for both of those. We're also expecting cybersecurity risk governance rulemaking. So again, the SEC is very focused on cybersecurity disclosures and risk governance. So something to keep an eye out for. Next slide, please. Okay, so I just wanted to highlight disclosure controls and procedures. I referenced it earlier in the presentation. In the context of climate change, this is very important, especially, with these areas of SEC focus, such as ESG and cybersecurity. You want to make sure that you have appropriate disclosure controls and procedures in place. So this is, everyone should be familiar with the Exchange Act rules that apply, because you do have to evaluate these and make certifications in your annual report each year. So I won't read the rule for you. Next slide, please. So I did want to highlight, that there is some guidance out there that's helpful from the SEC that relates to your disclosure controls and procedures. So recently, the 2020 guidance, when KPIs and metrics are material to an investment or voting decision, the company should consider whether it has effective controls or procedures in place to process information related to the disclosure of such items to ensure consistency as well as accuracy. So the point being that anything that's outside of your financial statements, you want to make sure that you have disclosure controls and procedures around those. Disclosure controls and procedures should not be limited to disclosure that's specifically required, but should also ensure timely collection and evaluation of information potentially subject to required disclosure. So that's that's important to note too. So even if you decide that certain information related to, for example, climate change or cybersecurity is not material and doesn't need to be disclosed, you just want to make sure that you have the appropriate disclosure controls and procedures in place to make sure that you're considering that information. Next slide, please. Okay, and a couple of practice tips here. So a lot of times, we'll see DCMP policies that are drafted, and they can be very comprehensive, but the focus is oftentimes on the process, and who's having the conversations and how things are escalated. But consider the substance as well, and make sure that you're aware of what you want to be putting through the rigors, what type of information. And then remember, as I said, disclosure controls and procedures apply to metrics, KPI, non-GAAP. So make sure that you're following your policy with respect to those items as well. You want to have a disclosure committee with a clearly defined role, and build out a timetable to filing and stick to it to make sure that everything is being moved through the building, as it were, in a manner that allows for the information to be reported in a timely manner, and be prepared for situations where something may be considered material in hindsight. So that's the situation where you're kind of considering, is this something that if the SEC is looking at this at a later date with more information, that this could be considered that it was material at the time. Next slide, please. Okay, and then just a reminder about the Pearson settlement that we talked about earlier. The company found, or the SEC found, that the company had inadequate disclosure controls and procedures, and so that's just one more example of where this could come into play for you. Next slide, please. Okay, and then just quickly in our last minute, I just wanted to highlight internal controls over financial reporting. So 404A requires management to provide a report over its internal controls, and if you are subject to 404B, you need to have your independent auditor assess them as well. Next slide, please. So I wanted to highlight a case that fairly recently the SEC brought. So it's internal controls over financial reporting. So this had to do with a company that entered into a 10b5-1 plan to repurchase shares. At the time, the CEO had plans to discuss a potential merger with another company. The company proceeded with the repurchase, and the SEC found that they were trading while in possession of material non-public information. So interestingly, there were no charges of insider trading that would require a knowledge component here, but the SEC order found that the company failed to devise and maintain a system of internal accounting controls sufficient to provide reasonable assurance that stock buyback transactions were executed in accordance with management's authorizations. They said they had an abbreviated and informal process. So just know, this might not be a situation you necessarily think of, but if money is moving, then that's going to affect your internal accounting controls. We are right at 1 o'clock, so thank you to Brian for presenting with me, and thank you all for joining us today.